thanks very much for the David Beckham story, Kev. I also want to point out that I am by far significantly his junior. So you're overdue in getting your tattoos as a genuine bona fide cafe racer. I hope you don't mind. I get myself a little bit comfortable here. It's fair to say, Kev, a very busy and long week. So after a couple of heavy cufflink meetings this morning, it's just nice just to release the tattoos, as it were. Just so you're no doubt just what kind of character I am. If you think my tattoos are controversial, wait till what I'm about to say. From time to time, I will just accentuate the gentleman thing. I might use my little beard comb just for accentuation. So I also might point to people from time to time if I think they're not listening. So get ready. Okay, we shall start. For those who may not have noticed, I am also Scottish. Unfortunately, logistically, we have not provided subtitles. I shall therefore endeavour to do my best to talk slowly. However, one thing I realised when I came to the beautiful South Africa, it is the only other country in the world, other than Scotland, that knows how to pronounce the letter R. And it's not R, it's not E, it's R. Right? So I doff my cap for actually being able to pronounce the letter R. So let us get started. Welcome. Welcome all. Welcome to the new fund order. Consider it a pre-apocalyptic view and futuristic expectation of the future of asset management. So you can appreciate this is going to be quite a fun ride. Indeed, I have come from far northern lands to share these views. And it is with warm thanks to both Kevin Hinton and RMI for welcoming me here. To the lovely Cape Town, then Pretoria yesterday, and of course here in Joburg. So thank you. And of course, thank you, dear friends, for joining us today. And you do sense it, don't you? Our industry has never been bigger. And yet, social unrest, an uneasiness about the future direction of a regulator, regulation, technology, a passive spring that we see globally, a regulatory shift. Underpinning it all, a digital revolution. The catalyst, as we have saw in the UK, was the retail distribution review. With it comes change, consolidation, indeed, concentration. George Orwell, too, knew this. He knew that state, power, and control often led to unpleasant endings. He knew too that those in power control the narrative, they control the truth about these things. Thus we huddle here, safe together, in these bunkers, in these rooms, to rationalize the likelihood of our digital death from robo. We try to reason that our survival hinges on our humanity, our professionalism, free markets, even politicians. But technology cares nothing for the order of things. Technology is a 200-foot Godzilla, and it is coming, unrelenting. It is in this context that I will draw on the topics that Kev mentioned. Asset concentration, the old fund order, the rise of supertanker funds versus boutiques, the advances of big data and machine learning, the automation of finance, and lastly, transparency and the direction of regulation post-RDR, the observations I can make in the UK, from the UK to you, and how it has affected advisors, fund managers, and indeed investment consultants. Now I'm sure you guys will hear plenty of technology speakers every year with big smiles and blue skies talking about how great technology is. But what they won't do is necessarily convey how it relates to you and to finance. I suspect you hear far fewer practitioners breaking ranks to talk about these issues. And after 20 or so years in this game, after 3 major market crashes, that's exactly what I did in 2015. I was compelled to write New Fund Order, a digital death for fund selection, ? NFO addresses technology not simply by its own advances, but inwardly, in terms of the dysfunctions already within asset management, within the analog, within the human condition. The human condition. Trust or control. Consider, my friend, the great Western philosopher Donald Trump. He once said, "I will build a great wall, and nobody builds walls better than me. Believe me, and I will build them very inexpensively. I will build a great, great wall, mark my words." Now, of course, what Donald Trump was talking about was not just physical walls, but political and economic ones too. In that highest office of trust, he instead sought control. He sought protectionism instead of inclusion. And in many ways, this is exactly what asset management has done. J.P. Morgan, one of the founding fathers of investment management, said, "A man does a thing for 2 reasons. A good reason and the real one." What RDR did in the UK was to sever and disenfranchise advisors from asset managers. In turn, the CEOs of every large asset manager embarked on a course of M&A, consolidation, acquisition, control. Assets have thus concentrated in the UK faster since RDR was introduced than before. Faster than fee margins have fallen. In doing so, it creates supernormal profits for those big AMs. And they deploy that free cash flow into acquisition, consolidation. They squeeze their rivals. They buy their rivals. They buy technology disruptors. Boutiques have therefore felt this pressure far more acutely than anyone. Love it, hate it, even fear it, robo has entered our daily conversation. Martin Ford, in his book in 2015, set out a very simple scenario. That for 150 years, machines automated the Industrial Revolution. For the last 40 years, robots have automated skilled manufacturing roles. For the next 20 years, robo will synthesize a high number of white-collar professions. Consider, in robo-sense, the Citigroup believe that in just the next decade, robo-advisors will be managing in excess of 5 trillion AUM in just the next decade. Reports that come out subsequently think this figure is even higher. And whilst we put that focus on robo-advisory, there is no technological impediment to robo infecting and taking over all parts of the current value chain in asset management. This is why I like to start with a few jokes, because it gets you in a good mood before I start to deliver the dark news, as it were. But within our human condition, those biases tend to narrow our field of vision. Robo quickly becomes portrayed as subhuman, dim-witted, Regulators too have shown very early concern towards robo and have put in place methods to try and curb its growth. Yet we seem somewhat blindsided, while simultaneously paranoid of the rapid advances in machine learning. This is because technology is moving faster outside of our industry than within it. So when disruption comes, it can happen very rapidly. Having largely operated unfettered for 20 years, the two laws that asset management cannot escape is Moore's Law, which is immutable. It is the expansion of computing power, which doubles at least every 2 years, and Parkinson's Law, which might be less familiar to you. An obscure British 1958 academic paper that talked about the inefficiencies in organisations. In Parkinson's case, it was the civil service in the UK, the more people you throw at a problem. We also call Parkinson coefficients of inefficiency. Historical examples have included the Roman Empire, Greater London Council, the civil service, the US Department of Defense, IBM, the British car industry post-Second World War, big banks through the 2000s, and yes, I'm afraid, asset management. In my paper, AM War Games, I assessed and analysed the ratio of human intensity per parts million of AUM managed across a large number of very large asset managers. I then compared that ratio to the performance, the median performance of those large asset managers. I concluded that most of the large asset managers today are facing huge inefficiencies across their portfolio desks. By comparison, boutiques, with already their smaller teams, their less human intensity, now have the opportunity to leverage technology to find scalability. Human intensity. This is what finance used to look like. All gone. Take actuaries. Apologies for actuaries in the room. If for the next couple of minutes you wish to peruse your BlackBerry in silent mode, of course, or indeed your iPhone, please feel free. This will pass very quickly. Actuaries, once the overlords of the long-term savings and liability model, unassailable. Yet, in 2016, the Institute and Faculty of Actuaries in the UK, being Scottish, I have a warm regard for actuaries. We are the founding nation of modern actuarial science. The IFA found that they had 29,000 members, which sounds pretty good, right? But 52% of those members were only students. They weren't fully qualified. 73% were aged 40 or younger. An entire generation of 50-plus baby boomer actuaries woke up, smelt the coffee, perused their healthy pension statements, and retired en masse. It leaves that profession in the UK in utter turmoil. It has sought out new revenue streams, like investment consulting, but more of that later. Meanwhile, Martina King wrote for the Actuarial Post. In the insurance sector, reducing the number of highly skilled, highly paid actuaries by replacing them with technology is attractive to companies. To put this in context, Martina King runs an actuarial recruitment agency. She also went on to say there are few open positions for individuals with predictive analytical skills. In other sectors too, organizations are slotting into job ads the request for experience in machine learning. It's worth the investment in gaining these skills to get ahead. Now, I delivered this cheery news to a master's class at University of Actuarial Science students. As you can imagine, they were very happy to hear these words. And yet, robo is still portrayed as a containable slave, a loyal servant. We make sweeping humanist statements around suitability, interaction, trust, judgment, wisdom, understanding, the fiduciary bond. Yet, the old fund order has progressively pulled investors into a handful of common strategies and failed often to deliver. Strange. However, for big asset management, the old fund order is still good. It offers a number of advantages. For one, size lowers operating cost base as a percentage of assets managed. Post-RDR in the UK, those savings have not been passed on to investors, but to the shareholders. Size builds in margin resilience in lieu of that fee compression. It throws off free cash flow to enable flotation, acquisition, or even the hiring of new talent. It allows for growing marketing and distribution budgets to press home the brand advantage. It pervades our whole industry, active and passive. It is founded on size and the annual management charge. Yet, with big, do indeed come less desirable symptoms. The industry has been slow to address diversity, sustainability, good stewardship, and social responsibilities. Advisors become very attached to star manager bias and safe, well-known options. Today we have too many funds, yet too many assets concentrated into too few. Asset concentration creates supertanker funds, yawing from one market to the next. All the while, more assets, more people. More people gets us right back to Parkinson's law. And asset concentration, being no doubts in the UK, was accentuated by the Retail Distribution Review. And there's somewhere in the region of 85 trillion mutual fund assets in the world today. There's about 20 or so trillion in the US, about 10 trillion in the UK, 15 in Luxembourg, Spain, Germany, France, about 5 trillion each. About 100,000 funds, yet 70 to 75% of that AUM is concentrated in only 10 global groups. The passive rise of Vanguard and BlackRock that we've seen in the United States and across Europe has only amplified and accentuated the problem. Globally, outside of South Africa, ETF providers dominate the sales charts like never before. That domination, again, leads us to consolidation. M&A, consolidation continues. It's all very much late cycle stuff. But when it comes to investing, big is surely good, right? No, not always, not now. The old adage of being big to get the biggest share at the table was from a time when markets were made. They were primary. They were broker-dealer organized. Today we live in a world of secondary markets, compressing settlement and clearing, electronic driven. Big demands more cash. Big demands more margin cover. Big becomes more subject to liquidity and market volatility. Big suffers from rising investor weekly flows, both subscription and redemption. Too much cash and you fall behind. Too little and you become a forced seller in times of stress. Big therefore creates friction, drag, and a lack of agility. When big tries to put large orders through the program trades, it leads to what I describe as yaw, what you might describe as slippage costs. Movements in the bid-offer spreads, spikings of prices, the market price moving around the trade initiation to the trade conclusion. Ideas become ultimately difficult to size into very large funds. Funds like never before have started to gravitate towards indices, or they become quasi-hedge derivative funds. Now, for those interested in this particular area, please check out my Bright Talk. There's one where I cover specifically supertanker funds, ways to think about liquidity analysis on those particular funds. In essence, I had proposed a model that would assess that yaw and slippage. So you could assess relative size to the impacts onto your liquidity analysis. All the while, an ensuing battle between those burgeoning giants and our fair boutiques. For large investors, unfortunately, investing in boutiques we know remains challenging. It asks new questions. We require new syndication models so that we can size appropriately into those boutiques. It supports the use of multi-boutique type strategies and multi-boutique type providers. Just another little note for the actuaries and consultants in the room. It's another little break for you. Please feel free to go grab a cup of tea. We'll be done in about 2 or so minutes. The sequence of events we saw in the UK could not possibly have been predicted. The retail distribution review set out clear aims, and we could see the impact to the advisor population. But the regulator was only just getting started. It was the subsequent thematic reviews after RDR that really hit the industry hard. Platforms, advisors, fund managers, and yes, consultants. We even see that shift in the regulator approach now moving across the EU passport via the MiFID II regulation. The real hitter was the FCA asset management study, particularly the interim report that was published 18 months ago. It made great criticisms of the investment consultant industry. They have found themselves not immune from the drive for transparency. So how did consultants get here? Well, we have to begin with the marketing mix. We've got to go back to 48, Professor Coulton. Then you've got Professor Neil Borden through the 1950s. And for those who have studied management, will probably recall Jerome McCarthy's book, published in 1960. It set down the 4 Ps: product, price, place, and yes, promotion. By 1981, we had the Booms and Bittner model, which added a further 3 Ps to the first 4. People, physical evidence, process. As a generation of Reagan and Thatcherite Ivy League graduates entered the industry, that culture of the management consultant took hold. It is no surprise, therefore, that their colleagues in the investment management side of the business adopted the same language when it came to assessing funds. Set down 1978, Russell's, one of the first. They launched their London office in 1981, quickly followed by the likes of Mercer. And yet, in the interim asset management study, the FCA criticized the aggregation of price into these multi-P models. In some cases, it found that investment consultants had only weighted 5% of their overall score towards price. They said that they could not possibly have enough focus on value for money when making recommendations to their pension scheme trustees. In this instance, they felt it had diluted the value of that process. The lesson for us is, instead of integrating price into your assessment of fund managers, if you consider it a separate hurdle, then you avoid buying any fund at any cost. And indeed, in Chapter 8 of that asset management study, the FCA continued to levy its criticism. It also questioned whether consultants and fund rating agencies should operate outside of the fiduciary perimeter, that they should be unregulated for the fund recommendations they were making to the scheme trustees. It criticized the relationship between the scheme trustees and their ability to challenge back their consultants. It challenged the technical competence of the scheme trustees to even select the consultants who were giving them advice. Lastly, it questioned the oligopoly that had occurred within the UK also happens in the US between the big four firms. The real blow was when the big four submitted their protest to this report. It was called the Undertaking in Lieu, the UIL. And they said, no, FCA, you don't understand our business. Here are all the good things that we do. Here are all our processes that control all of these issues. You don't understand what we do. The FCA goes, well, yes, I do understand what you do. And thank you for your undertaking in lieu, but I'm just going to ignore it. The real blow was they then referred the big consultants to the Competition Markets Authority. Now, in terms of scariness, I would perhaps describe the FCA as Homer Simpson. Makes a lot of noise, means well, doesn't always scare people. The Competition Markets Authority is a senior enforcer in the UK. It is Rambo. It is Arnold Schwarzenegger. And trust me, he will kill you. The Competition Markets Authority in the UK don't do consultations. They do investigations. And trust me, this investigation is a doozy. Every 2 weeks, a new working paper. Advisor research, asset manager research, consultant research, consumer research. No stone left unturned. They have challenged trustees. They have challenged the consultants. Now, whether consultants had just become very good at convincing trustees into mediocre choices, the jury is out. But be in no doubt that both the FCA and the CMA in the UK has put active fund selection on watch. It has put investment consulting on watch. And also, we expect those oligopolies to start to break down, because probably one of the most likely recommendations will be mandatory tendering of consultants, probably on a 3-year rotating basis. Right, the consultants can come back in now. That's good. So why is all this happening now? The destruction of trust and the hangover that's persisted for the last 10 years cannot be underestimated. Where finances truly become tested is in justifying its own economic value. So what is OEV? Well, you can think of it in the simplest sense as the alignment between the investor and their investment outcome. It's a piece of rope between those 2 points. How direct it is. How long is it? How many people are involved in it? Is there a tautness to that rope? Is there transparency? Where it's found lacking, we see immediately the symptoms across the globe. A move to passive, an ETF wave, fee transparency, criticism, indeed, of fund selection. In the UK, as a consequence of this, we're now going to see all UK fund boards move to the US fund board model with a minimum of 2 independent directors. You can guess what they're probably going to be charged to look at. Cost, value for money, etc., etc. The subtext is the worrying bit for me as a professional fund investor, because the subtext of all of this has been that active management doesn't work. Well, if the world's active managers are being criticized for not delivering excess returns globally, what does that mean for us as those who are charged to select those active asset managers? But step back and we can see that what really is happening here is a systematic removal of human intensity from finance. Just think about it. Until the late 1970s, hundreds of clerks used to write the futures prices on chalkboards and then record them to Polaroid film. Thousands of traders walked the pits. Accountants, actuaries, typing pools, administrators and human computers processed, calculated, deliberated and predicted. All gone. The start was Instinet in the very late 70s into 1980, which could bypass the trading floor quickly superseded by Archipelago and Bloomberg through the 80s. This then began to replace the floor traders. In 2000, there were 150,000 people involved in the securities and derivatives contracts in New York alone. By 2016, there were less than 100,000. And yet the market that they were serving had grown fivefold. So what next? What next of the new fund order for the next 20 years? Well, finance structures will continue to evolve. In this respect, the new fund order is unrelenting. Will technology companies simply just take over? Yes, but perhaps not in the way that we perhaps previously expected. I don't think Amazon is just going to come in and take over. It could, by the way. The balance sheet of Amazon is 300 times the size of Vanguard's. Amazon could buy Vanguard and BlackRock combined from its daily free flow cash flow. If Jeff Bezos wanted to. But I don't think he does, because he doesn't have to. There's a fantastic feedback that empowers technology companies because they dominate people's portfolios. They're among some of the largest capitalized stocks today. So they are already in your clients' homes. They're already on those portfolio statements. Also, there's technology firms who control the cloud, big data, AI, can change the asset management market at will from inside. They are your favored supplier, your data warehouse, your shared space, your co-op electronic messenger. They are everything that you probably use in your day-to-day lives as a finance professionals is already being provided by a firm that's probably already owned by one of the giants. If it isn't, and it's successful, it will be. But until recently, I was convinced that technology firms would simply just come in and take over. And then Cambridge Analytica happened. And what that did, what it has put big data in question. It's questioned big data from a fiduciary aspect, just as finances. Paul Smith, in his annual CFA address from Hong Kong, talked about a better brand of capitalism, a more purposeful model. And I'm warmed by that, because that's what we have to do. If we don't, then we will have failed, and investors will seek out technological solutions to replace us. Whatever happens, we will move towards clearing and settlement in a T0 scenario. We'll see new investment structures emerge. Traditional mutual funds will just quietly morph into these. I see a move from volatility-based risk ratings to the likes of pure style research or indeed Risk Lab. That move to factor analysis can allow us as buyers to ask new questions of fund managers to better understand how those funds in your portfolios are positioned for the current and for the next economic cycle. It allows you to better understand the risks in a holistic way and the drivers for fund managers behind their sales flows. Don't worry, Kev, I'll give you a little factor analysis tutorial later. We'll talk about this, right? In the future, factor analysis could even help drive new benchmarks. Sharing Alpha, as Kev rightly noted at the start, is the world's largest fund rating platform by number of analysts. In the space of 18 months, it has accrued over 1,500 fund analysts in over 55 countries. And it doesn't employ a single one of them. Playing the Scottish card, this is where Adam Smith's invisible hands help drive that competition between those fund analysts. You get positive benefits of aggregation, but also sharing of insights, community, and importantly, the analysis of those fund raters is tracked. their performance, their hit rate. In doing so, by offering that independent, validated track record, becomes then a commodity back to those fund buyers. It becomes their shop window to say, I can select funds, and I can justify my outperformance relative to a series of benchmarks. Together with the likes of Fundhouse, I truly believe that sharing alpha is disrupting the fund rating space. Kev mentioned near the start of the session about the Association of Professional Fund Investors. I'm one of 3 directors of the Association of Professional Fund Investors. It was founded in 2011 by fund selectors, for fund selectors. Feel like I'm about to start the Gettysburg Address. Of the people, man. No, I'm not going to do that. The APFI is a non-profit organization. It's incorporated as a Swiss charity. It is global. We have members in the United States, in the Nordics, across Europe, in Asia, Australia, and now here in South Africa, led by my good colleagues Red Daniels at GT Capital and Gandhi at Conceptual. Working heavily for 5 years on a due diligence questionnaire template, we sought to do one thing. Where can we find efficiencies in the due diligence process? Where is the commonality across the world between fund buyers and the information they seek? And how can we use technology to make that more efficient, faster, and work better for fund buyers? It led to Door. Door is one of the world's truly first eDDQ platforms. It's run by fund buyers for fund buyers. In every region, we have a guidance panel of fund buyers and APFI to ensure that the template incorporates the information that you need from your fund managers. What it does is it shortens the due diligence process rapidly. There's huge economies of saving here back to your asset managers. I also see growth in the likes of eRFP services like Invest RFP, Fund Info, and also search services like Fundbase and Murano Connect. I genuinely believe that eDDQ and eRFP will transform something that really hadn't changed for 20 years for us as fund buyers. FinTech will even give you solutions to your ESG conundrum. How, as fund selectors, do we gather data, analyze data, assess it in context to our fund managers, and try to address our principles of responsible investment? Because they are the questions we're being asked for now. How are we responsible investors? How well do we understand whether our fund managers have truly integrated ESG, truly have addressed areas such as environmental risk, sustainability, corporate governance, and the likes of Sustainalytics, South Pole, MSCI, FTSE have all created tools that can actually help you do that. Okay, this is where we start to get a bit trippy from a techie point of view. I'm not going to labor too much in about blockchain. I will make it an opening statement. This has nothing to do with cryptocurrency. Blockchain and the Internet of Things is the future of finance. You may choose to disbelieve that, but I hold it to be true. Because everything in blockchain, and the way it operates, the way it self-perpetuates, the way it self-protects itself, is a far more efficient system than the traditional mutual fund structure that hasn't really evolved for 50 years. So we have these various things. The block headers, the Merkle roots. The Merkle roots is almost like the rules of the blockchain. Every transaction is checked back against. Every transaction has to be spot on. If you create your fund or your portfolio using blockchain, as the block advisor and the fund selector, you could use something like Ontonix or Universal Ratings to assess the complexity of your portfolios. Those who have studied complexity analysis systems, CAS, complex adaptive systems, will know that the rising amount of complexity within your portfolio is actually a rising risk within your portfolio. Where you might think you have diversification, you actually have potential for T1 correlation, delta 1 events. in times of stress, this is where you're going to suffer. It challenges the traditional optimizer, the capital asset pricing model, the Black-Litman's model, which is, look, let's just bunch a whole different types of assets based on a covariance assumption, and we'll get diversification. Well, I'm afraid markets have become too complex for that. Those correlations now are shorter lived than ever before. You need to understand interconnectedness to truly know when you're getting diversification or if you're just increasing the risk. Don't believe that financial markets are complex. This is the fund platform I look after in the UK. Every dot is a fund. I'm not expecting, maybe the actuaries are back in the room, they're probably counted how many there are by now. There's about 867 up there. You can't even see the outer perimeter in some sort of crazy Star Trek scenario of all these little funds are out here. The scary part is the lines are cross-investment between the funds. This is why I believe we need serious computing power to enable our jobs. And indeed, much is talked about AI or artificial intelligence. And what caught my eye was one report that forecasted that the global GDP effect of AI by 2030 would be an increase of 14%. What is that? That's 15.7 trillion US dollars. That is more than the combined output of China and India combined today. And what is changing the possible is nothing new within machine learning. It is differentiable neural computing, or DNC. Some of you might already be aware of what DNC is. We've all seen it in the news, but perhaps didn't recognize it. DNC powered a program called AlphaGo. It beat the best Go player from Korea in the world at that game, across 250 to the power of 150 possible moves. DNC creates digital wisdom. It both can read and rewrite its own memory. In this way, algorithms don't have to have every single outcome at inception, but it can effectively iterate and learn as it goes through. It's a fantastic way to scale literally hundreds of thousands of different algorithmic pathways in one program. Then you've got researchers at Microsoft and the University of Cambridge developing DeepCoder. DeepCoder is a type of program we call program synthesis. What it does is it's a piggyback program. You give it a problem, it goes onto the internet, and it will sweep literally hundreds of thousands of different algorithms to find a solution. It does it literally in seconds. And when you think, according to Stratified, there is 30,000 gigabytes of new data on the internet every second, then that's a lot to piggyback. So if you start to mate DNC with program synthesis, then you could create a neural architecture that would far exceed the objective judgmental decisions of a fund selector and would get us much closer to the subjective biases of the fund selector. Even as far back as 2005, Robert Ludwig and Michael Pavioso proposed a manager selection using 3 different types of approach: naive Bayes, neural network, and decision tree learners. And they found the results indicate that machine learners can be used as a decision support aid to improve the selection of money managers. In some respects, they were being polite because in the test experience, they had a large number of actually human test subjects as well, fund analysts. And the machine learners outperformed every single one of them. But fintech, can it actually challenge the core of the human-to-human relationship? Can fintech be good? Well, consider that Nietzsche said, there is no such thing as good. Good is simply the herding instinct of the individual. Or think that 200 years ago, the Scottish investment industry set down the bedrock for fiduciary. Ubere me fide in utmost good faith. You'll recognize it. It's almost our mantra. It was written into those first actuarial contracts, those first Napoleonic bonds. So whilst good might infer that AI has to acquire agency or self-awareness, this is not true. We don't need AI to feel good about itself for being good. We only need AI to do good things. And Morningstar seized on this year, whereas these rantings of mine would be just the stuff of science fiction. Today, Morningstar launched Q Ratings. Now, Morningstar Q Ratings will probably go on to become the largest fund rating platform in the world. What Morningstar Q does is it takes the human mappings of its 180 global fund analysts, synthesized them into algorithms, and then created an AI machine learning fund rating platform. Where it gets tricky is, what Morningstar are going to do is they're going to apply that to every fund out there that their human analysts don't cover. Now, their human analysts only really screen about 10,000 funds out of a universe of 100,000. They only rate barely 1,000 of those funds. Morningstar Q will rate every other fund that's already available. Now, this sounds really good. If you actually look at the Morningstar PR on this, it's very harmonious. It's machines and people working together. It's the best of both. Until the Q ratings start to outperform your really expensive human fund analysts. Then you have a problem. Likewise, Larry Fink, much to the gall of his portfolio managers, has said that the future of active asset management in BlackRock is going to be his SAA quantitative group in the Bay Area in California, a black box asset management team. Indeed, it's not just words. He's already sacked 17 portfolio manager teams in the US and moved the assets to the quant model. Now, for those who are particularly interested in this area, I present a lecture for FinTech Circle Institute specifically on the robotization of mutual fund selection. In there, we'll examine a number of quantitative and qualitative techniques of how we go about selecting fund managers, and we'll also go through about a dozen different types of algo mapping and how you could actually then use that, apply it to your own portfolios. But AI does face a number of challenges. Firstly, those protections need to be hardwired, outcomes monitored, and the programmers regulated. Indeed, in the UK, the FCA, in its consultation, CP 1725, has done exactly that in its new certified regime. Algo programmers now in the UK will have to be certified if the algo program is running customer assets. And at least Robo can start with the 3 laws of Asimov, otherwise known as the 3 laws of robotics. Rule number 1, the robot can't harm the human or through an action allow the human to be harmed. Rule number 2, the robot must do what it's been told by the human, unless it contravenes rule number 1. And rule number 3, the robot must protect itself. And you guessed it, unless it contravenes rule number 1 or rule number 2. And this won't be easy, because what I see, particularly in big finance, is that finance professionals don't understand code, and coders don't understand finance. So tomorrow's finance professionals, tomorrow's fund selectors will understand the balance of both coding techniques and finance. It is here where I believe small boutiques and startup fintechs can work together to find those new solutions, unencumbered by their legacy ways of working. For example, if you mash up blockchain with AI, you could do some fairly interesting things with an exchange-traded fund. You could actually start to involve adaptive trading across thousands of assets. You could literally manage thousands of individual investor pathways through their journey. It would allow cross-investment between the investors, frictionless, devoid of tax, super efficient. In doing so, you would utterly compress the cost of investment. You could use what already exists, efficient electronic trading platforms and pricing mechanisms to ensure efficient mark-to-market outside of the blockchain and indeed inside. Then, suddenly, passive becomes social. Benchmarks, clearers, market makers, index providers suddenly become meaningless. As an advisor, you can literally advise all of your investors according to their each individual needs within one single mega block. This is an entirely new way of thinking of how to pool investors together. In there, you would have an algorithm mapped for every single investor to understand their needs, their maturities, their cash flows, to understand every single trade would be coded for purpose, specific to each investor. Your Asimov test becomes your safety net. It ensures that the algorithm constantly checks itself, so it's in line with the needs of the investor and your risk-stated aims. Now, this all feels a world away from finance today, so I appreciate that. Yet, in many ways, the old fund order is already dead. It just takes a long time for the nerve endings to tell the central brain. In the meantime, globally, large, creaking, free-float passives act as a methadone for the masses. And whilst Karl Marx could not have possibly anticipated the fourth industrial revolution or social media, his words today resonate more 200 years since his birth. Division of labour, machines, rising competition between humans, humans becoming displaced in the capital model. And so, I turn to you, dear friends. I wish you well as Godzilla approaches. To survive, we must evolve. In the new fund order, the case for multi-boutique, in my opinion, is compelling. A balance of economies of scale, yet technological scalability. Less human intensity. So consider engaging fintech. Consider agile boutiques over big AM. Better efficiency. Embrace new tools. Learn new skills. Integrate machine learning into your processes. Control your future. Build trust. Become cyborgs. The new fund order has just begun, and don't worry. Be happy. Thank you very much.
I'm sure many of you, like me, was kind of overwhelmed when I first heard JB's presentation in Cape Town a few days ago, and all the sort of mathematical and theoretical part of this particular exercise. But I think what JB managed to do is to bring it down to grassroots levels in many respects. We found a lot of richness in the other centres around dialogue. So we used some time to field questions from the floor. And I'd like to suggest that we open up the floor for a number of questions to JB on this very diverse subject matter. I don't know who's going to be first. I know the portfolio metrics guys here, where's Brendan and company, so this is right up your game. Andres from Analytics. Jim.
JB, I understand that I've seen a few advisor proposals from the UK, and I believe that they often still charge an advice fee of 1% per annum. In that environment that you've just described, how do they manage it? Considering the low returns that we've seen in the Western world of the last 10 years, how do they still get a 1% advice fee?
That's a great question, Jim. For the South African friends, you don't often get a Northern Irishman and a Scottishman in the same room because it can get a little feisty. So just be aware of where your exit is. We'll be fine. Jim, that's a great question. If it doesn't look right and it doesn't sound right, it probably isn't right. The reason some of these things haven't unwound themselves yet is inertia. There's also a massive problem we see in the UK, and that's one of investor apathy. I think it's incredibly difficult to make investors engage with their portfolios. It's one of the great sadnesses, actually, that the advisor population, as the result of retail distribution review, compressed. Probably just at the time that investors really needed a financial advisor. And what happened was, it actually raised the cost. If you were a financial advisor, you would effectively go through your list of clients and draw a line and say, no more for them. And it orphaned millions of investors in the UK. And so what's happened is the large banks and robo-advisors are moving in to fill the void. But where you see costs and you can't justify it based on optimum economic value, it probably shouldn't make sense. The only reason it is because of inertia.
Can I ask also, JB, just while you're on that subject matter as well, because we had this conversation in the other centres, just in terms of the robo-advice model and what you're seeing really emanating specifically out of the UK in that respect?
So this is going to be like trying to assess today's iPhone based on an Atari 800 from 1983. You can't possibly relate the two to each other. And what we saw with the first wave of robo-advisory, they were mostly rubbish. Also, they were not robo-advisory. Most of them were pooling mechanisms and robo-investment management. They would pull them into risk-guided approaches. Anyone who's ever had the pleasure of listening to Paul Resnick of Phenometrica know that is complete hooey. That is not robo-advisory. Robo-advisory is understanding the needs of the investor and synthesizing that through some sort of application. So what we've seen initially is pretty mediocre. The active asset management industry and the wealth managers have lobbied very hard, and therefore now the robo-advisors in the UK are now going through a very punitive regulation from the FCA. But that's the first generation. It's a bit like, if for those of us who have been in this game for a while, trying to make a comparison between the global tech giants of today and those crazy PE tech stocks of the dot-com bubble. You can't relate one to the other. So what I think will happen in time is we will see new generations of robo-advisory as the technology becomes available. And then it will start to push the game forward. What we have at the moment is not robo-advice. It is just the beginning.
There were lots of questions in the back. Let's see whose hands is up. No? There we go.
So, in terms of the fund management process, because I mean, essentially, machines are rules based, and they take the human element out. So it opens that conversation with regard to the passive or rules based investing relative to human intervention, decision making, and so on. And how does that? How do you see that manifesting in terms of the overall scenario as well?
So Kevin and I have been having some great conversations through this week as we've been travelling together. I've now seen much more of Kev than I have my wife in the last couple of weeks.
I'm sure you're delighted to get back to your wife tomorrow.
And we talked about bifurcation. There's two opposing camps. What's actually happening is you don't have that clear distinction anymore between purely human, fundamental, qualitative type investing and machine learning and rules-based investing. It still exists. It's actually got huge amounts of AUM currently displaced into those types of strategies. But what's happening in the middle, like BlackRock's SAA group, is mixing human judgment with machine learning, with algorithmics, with self-learning, and is bringing them all together. Why? Because you need that combination of robot and human. If you actually look at things like, for example, which some of you will have seen with some of these strategies, analyzing and measuring geotagging data for the retail market, or footfall and capturing that, or satellite pictures, you do need some form of machine learning or artificial intelligence to make sense of it. But you still need human creativity at this point in time. Much about good fund management is not just the availability of data. It is to make connections between what seemingly disparate data, make those connections, and then from that build an investment thesis. This is the last part that the computers will be able to synthesize. So those rules-based, whilst they've become very popular, are based on economic schools of thought that are now knocking on 45 years old and are now becoming popular. So I don't really want to think about those because they don't represent computerization or the latest in quantitative analysis. What's interesting to me is what Larry Fink is doing at the likes of BlackRock. And all of the big houses are now doing this. And it is the integration of machine learning with big data and human judgment. And that's the interesting part.
No. Yes, Lucy.
In markets where ETFs haven't taken off to the same extent as the US or some of the other markets, maybe similar to what's happening here, what's your sense of the reasons for that?
So fairly simply, one observation I've noted from around the world, because retail distribution review is actually a global phenomenon. It's everywhere from the UK, the Netherlands, Australia, United States, albeit in various different shades, some being unwound, some being diluted, some more aggressive. The general relationship I see between the ETF wave and the retail distribution review is 2.5 years on average. So the moment retail distribution review takes effect, start counting the clock. Because what happens is the drive of fee transparency and fee compression logically start to play to the exchange traded fund market. And you don't have the big ETF providers coming down here yet in force. You know when you will. Because Joburg, you'll see BlackRock come down and they will build the biggest tower right in the center, in Sandtown. Then you know the ETF providers have come. When Vanguards and State Streets and BlackRocks come here in force, and by the way, when I mean force, like 20,000 people will land and then start setting up operation, then you know the ETF wave is coming. I think the question you have to ask yourself is quite a simple one. Why would South Africa be different to every other country in the world in terms of RDR? If you could think of maybe a legislator or a regulator, goodness knows, if you had a bit of political corruption, if you could bribe someone or an official to not let the ETFs in, you've got a chance. If there's no difference, you have 2.5 years. And so then the next question is, what type of ETFs as fund selectors do you want to buy? Don't consider ETFs as something foreign to your mutual funds. They're not. They're just another type of investment transmission. Your mutual fund managers will migrate to ETF if they see the efficiency. And you will see the efficiency. They will help lower your portfolio costs. But it takes time. The US ETF industry has gone through a lot of teething problems. So they've got a lot of things worked out. And it will actually give you a mixture of active strategies, smart beta strategies, beta. It will allow you to do tactic asset allocation in a more efficient way than ever before. It will allow you to make some clear distinctions between when you want to be in an active strategy for the long term, because you want to invest in that potential realization of alpha, versus when you just want to make sure you cover a risk or have exposure to a particular market, and you're maybe thinking a shorter trade, 18 months, 2 years. We all know here that traditional mutual funds make no economic sense when traded in the short term. They generate vast frictional costs, but only so much of them you actually see. What's changed in Europe through MiFID II is that all the active asset managers and passive are going to have to report on the frictional costs of their trading. We're going to go from thinking we're paying 30 basis points for a particular strategy to suddenly paying 3% per annum. It's going to change the narrative in terms of value for money and cost. But I would say to you, as we've found in Europe, the United States, the Nordics, everywhere else, once you get past that difficult phase, it actually gives you a far broader range of investment choices. Yes?
JB, if artificial intelligence gets better and better answers and eventually ends up at, let's call it the truth, won't it bring optimal efficiency to market and therefore just buy the market?
Do you know what? I debate that. I'm not a mathematician. I'm neither a quant, I'm pleased to say. But I count on some of my best friends who are fantastic mathematicians physicists, engineers, etc. And one of my think tank back in the UK, please Google for this, it's called Long Finance. It's a ZGN think tank. They made a spoof film in 2010 called Ultra Hedge. In fact, I've used it sometimes in my presentation, and it's exactly that. It was a spoof presentation of what if we had just given the power to the computers after the great financial crisis. And through this, basically, the algorithm decided to hedge and arbitrage every asset in the world, and then every market just went like this, flat line. Then it wasn't finished. Then it decided to try and arbitrage the humans, and then set into place strategies to take out the humans. Then it wasn't finished. Then it decided to arbitrage the universe, and eventually compressed into its own singularity. For those who are into mathematics, there's a lot of in-jokes in there. So potentially yes, because we're still dealing with a secondary market, order-driven, that's utterly driven by human behavior. But it's not driven in a logical way. And so you might bring a system in there that then brings balance, and then you don't actually get a meaningful return. I think it would be interesting to see if AI would value Amazon at 200 times price to earnings. Because it's only going to be the computer that's going to still be around in 200 years to collect that. So, good question, thank you.
I would suggest that if these sort of things continue perfecting, what it does is it actually just takes out the defining need for human beings to actually, in other words, the normal curve distribution scenario. So it basically just flattens the normal curve. So then what will happen is that other means will actually be found for for the right-hand 5% to actually find ways of adding value.
I was going to say, you have completely understood this presentation. You get it. This is the danger. If human entity is stripped out, what do we therefore do with the humans? Non-physical vocation and profession is one of the last mainstays. I'm not too sure I agree with the socialists and the liberals that saying, well, we can all just go and become creative and do pottery and paint and think about, return to the Greeks and, philosophize and think, what does it mean to be human? I also don't think that the capitalist model, particularly that of the more of the right-wing model era of capitalism, could accept something like universal basic wage. So when I go back, this is why I start these presentations talking about the human condition. The humans will resist change. The difference this time round is that finance doesn't control the capitalization anymore of the tech companies. The last time we controlled it was the great financial crisis. Since then, technology companies have used indexation and passives as a means to capitalize themselves. So those of us in finance can no longer suppress their rate of advancement because they've access directly to our investors directly in the household. And be in no doubts, the feedback of that is tremendous. They see it in their portfolios, looking meanwhile on a device provided by the company they're looking in their portfolio. Huge self-validation. And that's the challenge for us. So I guess the recommendation to you guys is just to think of how we can incorporate technology to make us as efficient as possible, and then still rely on those areas such as creativity and cynicism and human judgment, which are the bedrocks of fund selection, to then continue to add value.
I'm particularly conscious of time, because we did say we'd finish at 4 o'clock. But I'd like to ask JB just one final question in parting. When can we get you back to South Africa? Because I think you'll all agree with me that I don't think we've seen anything like JB down in this part of the world. I think the subject matter he's brought to us is so diverse and so challenging. I'm sure you don't agree with all that he said, but I think if anything, he's triggered some sort of thought process with all of us about our industry by and large in every constituent of that value chain. So on that particular note, JB, we'd like to thank you formally for coming down to this part of the world. I sincerely hope that you enjoyed your time in South Africa and you'll take back our message to the world. about how beautiful our country is in the first instance and bring as many of your Scots tourists down here. We need you badly. We need the currency.
Good for the economy, so.
But I think you'll all join me in sort of saying thank you very, very much for making the time to come and see us.
Thank you very much. Thank you. That's good.
I thought it was a fantastic session. I think all these sessions, stimulate thoughts about what's changing in the industry. We're living in a dynamic world where clients are particularly disappointed with performance in markets, and a session that starts stimulating thoughts about where's the innovation. The old order seems to be under threat, so it's really interesting to kind of get some of the thoughts about where the trends are and what potential future innovations we should be expecting and thinking about. They may take some time to come to bear, but those thoughts and innovations I think will stimulate a lot of change in an industry that probably needs some change and start focusing on client solutions. Yeah, I think South African capital markets are quite different. I mean, you've seen South African markets dominated by Rand hedge, and the large asset managers have been able to perform, and the boutiques have struggled to kind of create a performance credential. But these things are cycles, so you'd expect that cycle to change, and it's inevitable that a boutique business that can find opportunities in inefficient markets should in fact start competing. There's no reason why size should be a competitive advantage. You just need markets to kind of favour them, is the view. It's interesting, I think the concept of a consultant purely focusing on manager selection is probably quite narrow, and a consultant probably has to have a broader role where they start constructing portfolios to kind of manage different risk, different return outcomes, different needs for clients. To simply focus on manager research, seems quite narrow when you've got quite a complex problem to solve for clients, and I think their role would probably have to extend for them to be relevant.
Exceptionally informative, an exceptional speaker in JB, different to what we're hearing elsewhere in the market. Potentially not what I might have expected from RMI, in that a lot of what we're talking about is, while it's talking about boutiques, there's a lot of focus on the robo, and potentially the need for underlying managers. Is there much more focus on ETFs, on the passives, etc. But exceptional discussion, a lot of room for thought and a lot of room for further investigation. Certainly something that we haven't heard much of in the market. Potentially the discussions are happening more overseas, but certainly really interesting and worth much more investigation. Just in terms of responses on the question on consultants in the UK, there's no doubt that those questions do need to be asked. And as a consultant myself, it's potentially uncomfortable, but they do need to be asked. I think there's the oligopoly, which we've seen. I wouldn't be surprised if we don't see some breakups. If we think about the South African market, you potentially have the same sort of effect, but maybe not to the same extent as the UK, although we're certainly seeing the big players moving in to try and replicate what they're doing overseas in this market. So I think change is in order. My experience has been, especially in the institutional space, trustee boards tend to be fairly conservative. They like to pick brand names. Nobody's ever going to get fired for mentioning an Alan Gray or Coro, whereas if you pick a brand that people are not aware of, questions can be asked. So that to me is probably one of the biggest hurdles that needs to be the one needs to get over. And also I think the boutiques need to demonstrate that they're better and different to the powerhouses, both in terms of risk-adjusted returns and in terms of behaviour. So it's not an easy one. People always pick the brands. Transformation is without a question one of the key issues that's going to be leading towards more focus on the boutiques, and that's a good thing. Transformation's got to happen. We're very excited about it. There's some great skill out there, and a lot of that's in the boutiques. So certainly as a consultant, that's something we're pushing strongly, and we hope it succeeds.
enjoyed the presentation. I enjoyed the robo advisors, and I think obviously it's something that we have to contend with, and it's where the industry is going as a whole. I think in our model, in sort of the high net worth clients space, I think it'll appeal more to the man out on the street, and I think it's a necessity to get something out there to the man who needs to invest. But statistics tell us in 2007 in America the average savings rate was 12.3%. I think that's the number. We need to confirm that, and currently it is like 3.2. So the question is, never mind the model, we need to get people saving more, and models alone won't do that. So I think advisors combined with new technology are the way to go. So obviously it's quite a new model in the industry as such, but I think it does actually give scale to other advisors that we may not consider. So it allows us to have access to fund managers that in the past you wouldn't really allow through the door, because you weren't sure that they would have all the procedures in place that would make them a viable proposition. So knowing that a company like RMI have partnered with them, you get some sense of credibility towards the partnership. So that's the first start. And then allowing them into the door and listening to what they have to say, combined with the expertise of RMI, you could offer your clients a blending of some fund managers that you wouldn't normally give them access to. So it's offering something that is unique and different. And in this market, I think we always have to be open to change. So I think it's quite good. So, I think the thing about the South African super tank funds is that the last sort of 20 years, they've had this market totally wrapped up. So you knew who they were, and you knew all about them, and they were the names that the clients knew. But I think they may have got a bit lazy, and I think their fee structures are quite expensive. And I think over a period of time, there are new people who have come on board. People who maybe have not made as much money as the big fund managers have, and I think they bring a certain passion to the business that we require. And I quite like blending boutique fund managers with the old traditional fund managers, because I find that the younger boutique fund managers tend to have passion and want to prove themselves and tend to work harder, whereas the older super tank fund managers, they're more interested in preserving what they have. And what they had may have worked in the past, but the question we need to ask ourselves is, will it be the future of financial advice? So as an advisor, we're always looking for change and looking for new and exciting and different ideas, and we need to be open to exploring all options.